Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab. This is long verticals and diagonals, and today we're going to be planning and placing an example long call spread, and I want to tie in the strike selection to what a trader might see on their chart. Should be a really good discussion. We're going to be weighing the pros and the cons of that spread, planning and placing some exits in our example order. So a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody who's chatting in out there in YouTube. Great to see so many familiar names. As always, hello, John, Mike, PR451, Paul Jackson, Ricebird, Marcus, Jermaine, Greg, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the show is concluded, we'll enjoy that recording. But be aware that you're invited to join us in a live discussion. This is a Thursday webcast series. We kick it off promptly, 11 Eastern. We'd love to have you here in our live stream audience. And I want to let our live stream audience members know that Barb Armstrong is back. She's going to be hanging out in the chat. She's going to be addressing any questions that I can't get to. Thanks for helping me out there, Barb. It's always appreciated. And Barb and I would also like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite presenters there. It's the very best place to connect with us in between these live streams. Barb's very active there. So am I. You can follow Barb on X at Barb Armstrong CS. You can follow me on X at Cameron May CS. But let's get into this discussion of long call spreads. And as we do, of course, we need to consider the risks associated with doing these sorts of strategies. This is important information, so bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. Okay, so here's what we're going to be doing with our time together today. Number one, this webcast is part of an ongoing series, so we're going to go to the current positions within our example paper money portfolio, see what's happened with a couple of those. We're also going to look at our two that are still ongoing and see if there's anything that needs to be done with either of them. And I think there is one that needs some particular attention today. Then we're going to have a quick look at the markets, see what the backdrop is for trading spreads might be. Then we're going to get to our discussion of building, planning, and executing a long call spread. And we're going to be using charts to supplement our efforts for strike selection. How might a chart user use that information to guide their strike selection? Interesting discussion ahead. So let's get to it. Let's go right to the Thinkorswim desktop trading software platform. So here we find ourselves, we have two remaining positions. We have GILD and we have Alphabet, but there are two that also concluded since we last met. So let's go have a look at those. First of all, we had AVGO. So Broadcom, we had a long call spread. Interesting. That's the topic for today. With this, we took that trade back here on July 18th, bought the 270s, sold the 280s. The preference here is for our stock to be above that spread as we get to that expiration. This was the August 15th expiration, and that's just to where we were. We sold 6 contracts at $6.90 per share. That's $690 per contract. Those were allowed to go all the way to expiration. In real life, here's what happens. We have the right to buy shares at 270. That's exercised. Someone else has the right to buy shares from us at 280. That's assigned. Buy at 270, sell at 280. There's a $10 spread. Now, I need to go double check my numbers. I actually, in thinking back on this, sometimes I do things a little bit quickly. In any case, the $10 is the maximum reward minus the cost to set this trade up. And I think I might have done my math incorrectly. Let's just revisit this 4140. Let's go to our monitor, go to the account statement. Here's that. Yeah, that's what I thought. This is such a rookie mistake. I'm going to forgive myself for it. But in any case, it was a 690 debit, which is the maximum loss on this trade. I treated it like it was the maximum profit. It's not the maximum profit. What's the maximum profit on a $10 wide spread that costs $6.90 to set up? It's $3.10, $10 minus 690. So how much did we actually make on this trade? Let me break my calculator out. And this is not including commissions. That would shave a little bit off of this net profit. But 310, and by the way, there were no commissions. Well, anyway, there were commissions on this trade. But 310 times 6 contracts is 1860. Let's make sure that's accurate. Edit this. It was an 1860. Next. All right. So we're good there. So nice little outcome on Broadcom. Not the same scenario on our next trade that concluded since we last met. Last week, we took a look at PG, Procter & Gamble. And Procter & Gamble had been going down and down and down. So what did we do? We bought a 157 long put, sold a 155 short put. Both of those were in the money at the time of this trade. And what we preferred is for the stock just to continue going down. Well, somehow, you tell me how. This is stretching the boundaries of credibility, I think. We somehow figured out how to lose money on a bearish trade in an incredibly bullish market. I'm kidding. But yeah, we did lose money on this one. Last week, I decided it's been a long time since we put on a bearish trade. Let's put one on, see what happens. This is what happened. The stock rallied. We hit our stop. We lost 990 on this trade. Now, there was a maximum loss that could still have occurred of 1750. So we stemmed the bleeding. Now, if the stock happened to fall back down below our strikes, we actually could be back in max gain territory. But this is one of the arguments for some traders that decide, even when they have a spread where they seem to have defined the reward and the risk, maybe they don't want to realize the maximum risk if it's avoidable. So in this case, that's what we've done. Stopped out. We put our stop at 50% on 1750. That only should have been 875. But it's a good reminder that a stop is not a guarantee of a precise execution price. In this case, it was a little bit larger. Bruce says, why not roll the short put? There are additional trade management techniques that might have been employed with this trade, right, Bruce? Some traders might have done that, but the short put, if we'd roll the short put, our long put is also still just taking abuse. So we'd have an unrealized loss on we'd have the realized gain on the short put, but the losses on that long could continue to grow. And that creates a new reward and risk scenario. Any new long short put that we put on would carry its own potential for loss. So it could compound things, just depends on where the stock moves from the time of the roll. So it's a good question, Bruce. What I do want to emphasize is that commonly rolls are kind of pitched like they fix a trade that's gone south. No, they don't. They end a trade and then get into a new trade that may, if it works out, assist with overcoming some of the losses of the original trade, maybe all of them. But if it doesn't work out, it may compound those losses. All right, anyway, let's go on to our current positions. We have GILD and we have Google. Prakash says you should have an out of the money call. Not quite sure what you mean by that one, Prakash. Here are our two current positions, though. We have Gilead Sciences, which right now is a $95 long call expiring in 665 days, a $125 short call expiring in 29 days, but that's not the whole story on GILD. So with GILD, we bought that 95 long call all the way back here, January 30th. You can see it still has a couple of years on it. So this is the example of the way that a trader of long call diagonal spreads may hang on to that long position for quite a while selling short positions against that. So we've done that several times already. Sold a couple. These ones resulted in losses as we rolled those. These new ones, we've had 2 losses. We've had 1, 2, 3, 4, 5 gains. But our new trade is up here at 125. That's off the top. Let me just drag this down. That's the position that we took most recently. Sold that 125 short call. The stock has kind of pulled away from that. So the short call is probably doing all right. How are we doing on that short call? Yeah, 145 is what we collected. 69 cents is its current value. I'm going to let that one just continue to work. Oh, Prakash says maybe you mean a long call spread because PG was declining. Well, so a short call spread, long put spread, they're both bearish. With either one of those, we very likely would have lost money, especially if we were doing a weekly strategy like we discussed last week. In any case, GILD, we're going to leave it alone, but Google, what's going on with this? This one, we have the 180 call expiring in 148 days. We've sold the 215 call expiring in 29 days. Looks like our 215 call also doing okay. 350 is what we sold it for. It's worth about $2 at the moment. So we'll go have a look at Alphabet here. Here we bought the long call, the 180 strike that was solidly in the money on this date. That's the blue oval. Now we sold a short call against that previously. This one, though, this is what we did last week. If you were here for last week's discussion, we were teasing dangerously close to having this go in the money. And you can see on Friday, it actually did go in the money. Now, even an out of the money contract can be assigned, but in the spirit of attempting to reduce the risk of early assignment, we rolled this. Now, interestingly, had we not rolled, this looks like, oh, nice, Cameron, you made a 26-cent profit. That's cute. But there was a lot more that we left on the table with that, but it was just so close. There wasn't an opportunity for us to meet on Friday to talk about it. So we rolled that up to the 215 short call. So we closed this one out for a profit, sold a new one up here at 215. So from here, we have more upside wiggle room for that long call to benefit from price going up, as long as we're below 215 at that September 19th expiration. It should minimize early assignment risk. Early assignment risk is always present, even on those distantly out of the money calls, but even on those contracts, but we've reduced that risk. All right, so Bruce says, remind me, horizontals are calendar spreads, diagonals are just vertical spread. Well, so Bruce, a diagonal is, I think what you're talking about is, so a calendar spread, calling it a horizontal is kind of an obscure reference to a calendar spread. But yeah, a calendar spread is just buying and selling options of different expirations, but at the same strike. A diagonal spread is buying and selling options of different expirations, but at different strikes. So another way that I think about it, and this is where the horizontal reference comes from, is that a calendar spread is really only distinguished by time. If we think of time as being linear or horizontal in its progression, yeah, so if we maybe we have a contract that expires in April and another one expires out in October, the only distinction between those is time, horizontal. A diagonal spread, maybe we bought a call at a $100 strike that expires later. We sell a call at maybe the 110 strike that expires earlier. So now there's a difference of time, but also price. So if we plot that on a grid, y-axis and x-axis, if we were to draw a line between the two, it creates sort of a diagonal visual. That's the way that I think about it. In any case, there we go. Yep. Let's get on to today's discussion, though. The topic of the day, we're going to be doing a long call spread, but using charts to guide the strike selection. But I want to make sure that we cover the rest of the pertinent details of the trade as well. So as we go to place that, let's have a look first at what's going on with the S&P 500. I know it's been kind of a rough week for the bulls. Interestingly, this week produced that loss on our bearish trade. That can definitely happen. But overall, this has been an incredible run. Since those April lows, the markets have just been storming higher with occasional retracements. So let's say that our trader is just looking at this last week of selling and just saying, well, this is something I've seen before in this bull run. We had a similarly proportioned pullback here, and a smaller one here, and a similar one here, and a similarish one here, a little bit one there, a little bit larger one here when things were more volatile. But maybe their conviction as they're planning out, let's say we're planning another trade for out here, the September 19th expiration. An important question becomes, well, does a trader think the stock or the stock market, that stocks in general are more likely to be higher or lower during that time frame? There's no guarantee in trading. Nope. But for some traders, they think that maybe they can nudge that the needle of probability a little bit in their favor if they can at least be on the same side as the markets. Because if we just roll back the clock and put ourselves in the shoes of traders that have been trading spreads over these last 5 months, if we had two traders of equal skill, but one was trading bull spreads and the other one was trading bear spreads over the last 5 months without knowing anything else about those traders, how do we think the two fared compared to one another? Probably the bullish trader did a lot better than the bearish trader. Not necessarily because of their amazing timing, maybe not necessarily because of the incredible stock selection, maybe not because of their experienced strike selection, but just because stocks just kept going up. And that can provide a tailwind for one approach and a headwind for another approach. So let's say that our trader here just thinks it's more likely that we're going to be going up rather than down. Okay. So we're going to be doing a bull call spread today. So let me just clear that drawing set and let's go pick a stock for our trade. Now, I discuss each time when I go bring up an example stock, what are some of the reasons why a trader might choose a particular stock? Can be a number of reasons. They may have convictions about sector strength. It might be about the fundamental strength of the company, but lots of different sorts of variations on why a trader might choose a stock and be bullish about a stock for a given time frame. But some things that tend to be a little bit more universal, not entirely universal because I can't speak for every trader out there, but very commonly traders pay close attention to the price per share. They pay attention to the liquidity of the stock and its options. And if they use charts, maybe they take a look at what's going on with the charts as well. So Bruce says diagonal spreads are a combination of vertical and calendar spreads. Bruce, I think that's a legitimate way to think about it. It's not technically accurate to say that there's a vertical and a diagonal that have been combined, but the net result would be that, yeah. So Jim says, why not do SPX? Because this webcast is not about trading index options. That's a good question, Jim, but we do have webcasts about trading index options. So I have a couple of suggestions for you. Number one, if you didn't get to see the setups for the trades that we already discussed today, they're on our archives on our channel. Or if you're interested in things like Jim has proposed, maybe trading index options, there's an index option webcast that you can check out. But if you haven't subscribed to our Trader Talk channel, do yourself a favor and click on that subscribe button right now. It's down there in the lower right-hand corner, or you can go down below the video stream and click on subscribe. That only takes a second. Doesn't cost you anything. We don't charge you anything to do that. But that subscribes you to the channel. And this channel is where we house all of our previous webcasts for our series. There are a few series that are not archived, but this one is. But the full name of our YouTube channel is Trader Talks Schwab Coaching Webcast. So you just find that on YouTube. And then you can go to playlists and look for, like, for example, my series. You just scroll on down. And mine's just a couple of lines up from the bottom. There it is, long verticals and diagonals. You can see that view full playlist. This is last week's bearish strategy, just didn't work out. The previous week, we did a bullish strategy, kind of in keeping with the trend of the markets. And what do you know? That one worked out. In any case, yeah, you can go back through and check those out. All right, so another thing I want to point out is there is a survey for those that are here in the live stream audience. If you want to do me this favor, click on that survey link right now. That'll have the survey ready for you to fill out at the end of the webcast when you give me some honest feedback. But it's just 2 multiple choice questions. There's also a comment box and a suggestion box. But if you take the time to fill out that survey, it helps. It goes right to me, And I read through those comments, I read through that data, and it helps. I just this morning was going through feedback from my most recent webcast. So thank you for doing that for me. In any case, let's go back to our trade scenario. And here's a stock that we're going to be using for today. I'm going to go back to a familiar. This was a stock we traded just a couple of weeks ago, Apple. So let's look at Apple through the lens of that chart user. I already mentioned there could be some pre-qualifiers here, price and liquidity. Price on Apple's 225. That's, in the way that a lot of stocks out there are priced right now, that's a comparatively low price. There are certainly some lower price stocks. There are some higher price stocks. But for traders who maybe are trying to stay away from the most expensive stocks and maybe not take on enormous obligations with any short options that they're selling, they might go for a lower price security. But if we get really low in price, it can limit the number of strike prices that are available. So there are pros and cons, but I'm going to be using Apple as our example today, one of the most liquid stocks in the world. But what's happened on its chart? But we traded this initially because we noted that there had been a break of a resistance right here at about that 215 level. And we did a quick 1 week trade that actually profited very quickly. We closed it out for a profit, but we blasted up through that 215 level. And interestingly, on a subsequent strong up day, we also got up through this 220, or actually 225 level of resistance. We've broken through that second level of resistance, or apparent level of resistance, and just like so many stocks out there, we've been pulling back over the last 5 days. But a technician might find it interesting that an old price ceiling may be acting as a new price floor. Look at where our stock is right now. It's hovering right inside that fine line that I've drawn there at about that 225 level. We're right there. And for some traders, they might want to wait for a white candle. Or for others, it might be adequate, or it might be sufficient to them. They've come down to what they suspect is likely to be a new support. Now, I'm going to throw in one more thing here. And that is, for some traders, when there's a strong move to the upside, there's a drawing tool that might assist, at least conceptually, with the identification of support and resistance levels, or just add technical evidence to previously identified support and resistance levels. That is our Fibonacci tool. So I'm going to use our Fibonacci tool. If you're not familiar with this, here's a suggestion I'd make. Go to our channel. And Fibonacci is kind of a long word. Just type in fibs. They're commonly referred to as fibs. But if you do a search for fibs, you'll see some discussions where I go into detail about how Fibonacci's are built and how they're commonly used by traders to plan and place trades. And you'll see other trades by or other webcasts by other presenters here. But for example, here's a beginner's guide to using Fibonacci's. You might want to check that one out. But let's go back to this trade. And when there's an explosive move through what appears to be an important price ceiling, what some traders will do is they'll wait for the stock to finish that explosive move. And as it pulls back, go to the top of that up move, click using the Fibonacci tool, and then go down to that breakout point and click again, because there's a common expectation with technical traders, and that is when a stock makes a strong move up, very commonly, there are some profits taken that maybe give us a retracement against that upward move. And also a common assumption there is it's likely to be about 50%. Of course, it doesn't always work out that way. Sometimes it gives back all the distance gained. But I find it interesting. Look where that 50% fib is relative to where the current stock price is, and also relative to the most recent price ceiling, right again at about that 225 level. So whatever approach a technician takes in establishing where they think those important price ceilings and floors are, That is commonly used to govern strike selection. So I'm going to do this. If let's just say that our trader thinks, all right, on the combined evidence of a break of resistance and a 50% fib, maybe they think that this little sell-off has run its course, and they think the stock is maybe more likely to rise as we move toward that September 19th expiration, or they think that 225 is likely to be a short-term support level. The trader may want to set up a long call spread, if that's their chosen strategy, just below that support. And I'm going to be relatively aggressive here. I might even set it right at that support if the trader's really confident in that. But let's go to our trade tab and start to build to today's example trade. So our example trade is going to be a long call spread. I'm going to go out here to that 19th of September expiration. I'm going to go to the strike that's right at our support. And if the trader's feeling comparatively aggressive, what if we were to do this today? Very commonly, I will go a little bit deeper in the money, go for a little bit higher probability. Let's tease those probabilities a little bit, get a little bit more aggressive. How about for today's example, we're going to buy the 19th of September, 222.5 call. That looks like that's trading between 810 and 820. That's going to be 815. And to create our long call spread at the same time, I'm going to sell the 19th of September to 5 call. That looks like that might retrieve about a 665-ish credit. So what is the trader doing as they're structuring this trade? Well, they've entered into 2 contracts. One contract, we're spending $8.15 per share on 100 shares, $815, but we're spending that for the right to buy shares at 225.5, and that right is good through the 19th of September. At the same time, we're accepting a payment of $665 for the obligation to maybe have to sell those same shares for 225. And the ultimate objective of this trade is for both of those contracts to be, well, ours to be exercised, the other to be assigned. If we have the opportunity to buy at 222.5 and sell at 225, does that sound like a good idea? Would we want to do that? Yeah. That would produce a $2.50 profit per share. And the way I like to say this is if this were a free trade. It's not a free trade. There is a net cost for this trade. The net debit on this trade, setting commissions aside, but this is also the theoretical max loss. Spending this, we could lose what we spent, is $815 spent minus $665 collected. That leaves us with, what, $1.50? A nice round number. Yeah. So if we wind up spending the $815 but keeping the $665 and both of those just expire worthless, ouch, we lost $815, but the $665 is a consolation prize. That would be our $1.50 loss. That's the investment in this trade. What's the theoretical max gain? Deepak says, by choosing 222.5 and 225, do we anticipate the price will be in that range? Or what is the thought process behind choosing those 2 price points? So Deepak, what we're actually hoping for with this trade is that the stock is above this vertical spread. Of it. So let me map this out on our chart. Let me clean up our chart. I'm actually just going to remove all of our drawings. Let's just clear up the whole drawing set and just focus on our 2 strike prices. So we have 225, which is right here, out through expiration. Oops, didn't quite take on that second click. Let me do it one more time. There we go. And then we also have the 222.5, which is right there. Let's carry that out to expiration. So that's a sort of visual representation of our 2 strikes. What we'd like is for the stock to do just what we thought it might do, which is to go up, or at least to just stay above 225. Look at that. It's doing what we hope already. It just went from 225.09 to 225.13 to 225.14. Let's hope it keeps doing that, because what would that do at expiration? It's working its way toward our maximum gain. I'll revisit that in just a moment. But what is the maximum gain on this trade? Well, if we buy shares ultimately at 222.5 and sell them at 225, that would be a 250 profit, but it cost us $1.50 to set this trade up. So that leaves us with $1. Now that would be $1 gained on $1.50 invested. Can you do the math on that for me? $1 gain on $1.50 invested is a 67% return in, how many days was this? 29 days. Okay. This is a high potential return scenario. It also is associated with a high risk, because we could make that dollar if the stock does what we hope it does. We could lose $1.50 if this trade goes completely against us. So we definitely need to be aware of both of these outcomes. Now, Naresh says, Cam, should we not wait for the bounce from the support level before taking this trade? Price could still be falling. It could, Naresh. Yep. So for some traders, they may wait for like a white candle to appear on a 1 year daily chart. If we were to look at this on a shorter term, let me look at this intraday. What's been happening just since we started building this trade? This is very slight technical evidence, but this is just what we would hope. Keep going, little stock. We need that to go up. Yes, for some traders, they might prefer to wait for more strength. Others, though, they might say, you know what? We're at support. That's as close as we're going to get where we can get these strikes and get the highest reward possible. So it takes a little bit of more aggressive approach, but maybe at support, but also at that Fibonacci retracement. Maybe they think that they have sufficient technical evidence, even in the absence of a white candle, to take the trade. It's up to the trader's preference. Not everybody even does long call spreads. But yeah, this is what could happen. Could make money, could lose money. So why do we prefer for the stock to be above 225? Well, let's talk it through. Let's say we're up here at 230. We hit expiration. Someone has the right to buy shares that are worth 230. They can pay us 225 for those shares. Are they going to do it? Yes, they're going to do it, with very rare exceptions. Options traders are not unintelligent people. They're going to say, hey, Cameron, give me those shares for 225 because I can get 230 for them at that moment. So they buy those shares from us. And I say, great, I can buy for 222.5. We exercise our right to buy for 225.5 or 222.5. We sell those for 225. That's a 250 value minus the $1.50 that was invested, gives us our $1 profit. That's it. Now, if it misbehaves, let's say we were wrong and our stock keeps going down, that's definitely a possibility. What if it's down here at 220 and we hit expiration? Well, this trader says, Cameron, keep your shares. They're not worth my money. I don't want to pay $225 for a $220 stock, so they walk. Awesome. They leave us with their $665. But at the same time, our contract where we have the right to buy shares for 222, that's not worth anything. Shares aren't worth 222. So we lose our 815. 815 lost minus 665 retained gives us a $1.50 loss. Okay. So those are possible outcomes. There is definitely a third possible outcome that the trader should always be aware of, and that is, what if we slip down in between our strikes and hit expiration? Well, now we might wind up, if we let this get to expiration, we buy the shares at 222.5 and we're waiting anxiously, okay, buy these from us for 225. They don't want them for 225. And we might wind up just owning shares. That might not be the trader's objective. So it's still a trade that we want to pay attention to, even if it hasn't gone down below our lower strike. Leon says, Cameron, how do we make the bull call spread less risky, even though less reward? Great question, Leon. So there are a couple of directions we could take this. So there's a teeter-totter with strike selection with vertical spreads. If we go for if we want the probability of success to go up, the reward potential is going to go down on that trade. On the other hand, if we're okay, if we want the reward potential to go up, the probability of success goes down. So here's how it would work. We chose the 222.5, 225. If a trader wants a higher probability of success, what they'll do is they'll go deeper in the money. And when we run the math on that, we're going to find that it's costing us net more and more to do those trades. It's going to leave less for reward, but it's easier for the stock to stay above the spreads that we selected. So yeah, deeper in the money, bottom line, is the higher probability of lower reward trade scenarios. Further out of the money is the lower probability, higher reward scenario. All right, but here we're pretty close to at the money, just a little bit in the money. Still a higher probability trade because we'd like the stock to be above 225. Look at that. It keeps cooperating. It keeps going the direction I would hope, but what that's going to be doing is it's going to also be increasing the cost, the ultimate cost of this trade as I'm yapping along and not placing the trade. But a final thing that I wanted to talk about today is planning for taking profits and taking losses. I need to go back here. Let's go see how much this is going to cost us to set up at this moment. Instead of $8.15, it might cost us now about $8.45. Calls are getting more expensive as the stock keeps climbing. However, that also means we can get a larger credit probably. Instead of $6.65, we might be able to get about $6.90. So that's increased the cost by about 5 cents net. It's decreased the reward by about 5 cents. So let's just assume this is what we ultimately are able to fill this trade for. Well, sometimes a trader might put this trade on and say, okay, I'm either going to make my 95 or I'm going to lose my 155, and I'm okay with it. I'm pretty confident in this trade. I'm just going to let it go. Others, though, might say, you know what, if I can make even a portion of that 95, I'm going to grab that. Or if I incur even a fraction of the losses and the trade's going the wrong direction, maybe I just want to stop the bleeding. So we're going to put in some example exits here. And let's say that our trader first decides, you know what, if I could just get 80% of that maximum gain at any time, maybe I just get one nice bounce up day or a couple of good strong days. If I could get out before expiration and not have to sit here sweating it all the way to the 19th of September, I don't need the full 95 cents, but let's try to get a majority of that. And they might want to go for a majority because there is a smaller reward potential here. And if we start settling for very small rewards, maybe that's a tough way to have a sustained career in spread trading, right? Possible. But at the same time, with this larger risk, we don't want to have a great big risk, a great big realized risk fall in our laps. How about with this, with the downside of the trade, we're going to give it some wiggle room, exit if the stock has already put us in a position where we're looking at a 50% loss, a 50% of that original loss. Sunrise, I'm not sure what you're asking about. Does Schwab have any classes I could take? This one, you might call this a class. It's a class on spread trading. I don't typically refer to my webcasts as classes, just a personal preference because I didn't like school. I don't want to stress out my audience, so you're just my audience. That sounds better, right? Sounds like you're watching entertainment. Anyway, that's going to be our example plan. This is not the way every trader manages things, but I just want to show how this might be done. So let's put in our trade. Quick way to place a trade is up here where it says spread single, and it's showing all the single strikes. I can change this to vertical, and now it pairs all those strikes up with each other. So then I can go right to the strike pair that we were interested in, 222.5 and 225, and click on that ask price to create that long call vertical. Now this is going to be, let's say we're willing to spend $1.55 to get into this. That would be $155 of risk per spread. How about we do 10 of these? That'd be $1,550. Let's dial that up 10 contracts. But now I want to attach 2 exit orders, one to take profits, the other one to take losses. So I'm going to change this from just placing a single trade or a single order to a first triggers OCO. That allows me to put in those 2 exit orders. And now I can just right click and create opposite orders. There's one, right click, create an opposite order. There's the other. So this first one, let's use this one to manage our profit. All right. If we're paying $1.55 and we want to make at least 80% of the maximum gain on that trade, what's 80% of 95 cents? 95 times 0.8. Well, if we could sell, let's call it 75 cents. If we can buy for $1.55 and then sell with a 75-cent profit, what price would we need? Wouldn't that be $2.30? Let's put in $2.30 here. Let's make that our limit order. In other words, if I buy for $1.55 this spread and I'm able to sell the spread for $2.30, that would be a 75-cent profit, setting commissions aside from the equation. And that 75 cents is about 80% of the 95 if we let it go all the way to expiration. Anyway, and if it were in max gain position. What about losses? We want to stop the bleeding if our investment has lost half its value. Well, half of 155 is going to be around 87, 88 cents. No, it's going to be a little bit less than that, isn't it? It's going to be 77, 78 cents. Let's call it, let's put in a stop here at 78. So in other words, buy at 155, we think it's going to go up in value. And if it starts to fall in value, we have a stop out there. Get us out if we've fallen down to or below 78. It's not a guarantee that we'll sell for exactly 78 cents. Could sell for less than that. That would just be the trigger price. But I'm going to make that good till canceled. And now we've planned for the management of profits and losses. It's still something we need to pay attention to. If it never reaches either of those extremes, we still want to watch this as it approaches expiration, may require a manual exit. But I'm going to click confirm and send. We're going to buy 10 verticals at 155. We're going to try to sell those for at least 230. Or if they drop to 78, we'll sell at or below that level. Now, regarding that stop, due to potentially wide markets or liquidity risks at the time of activation, if that's activated, that order may be manually substituted with a limit order upon activation and then worked until it's filled. So I'm going to send that order off, and off we go. Okay, so let's keep an eye on this. Let's see, 155 is the mark. 155 is what we're offering to spend to get into it. I think there's a good likelihood that we'll get a fill there. I'll keep an eye on it, but time for me to let you go, everybody. We've accomplished what I set out to do today. I wanted to talk through a long call spread. This is a long call spread explained. We talked about pairing up strike selection with what a trader sees on the chart, and we've entered that trade with exits to manage profits and losses. Hope that was a helpful, useful discussion for you. This is what we do on Thursdays. If you enjoyed this webcast, I hope to see you again next Thursday. Of course, you can also watch the archives. That's a fabulous way to do it too. But I have some suggestions for you as I turn you loose. Number one is to make sure that you subscribe to our Trader Talks channel. You can subscribe by going down the lower right-hand corner, clicking on that subscribe button. It only takes a second. It doesn't cost anything. But our Trader Talks channel is where we house all of these webcasts. Not every single one. There are a few that aren't added to our playlist, but the vast majority of our webcasts ultimately find their way to our playlist here. Actually, pretty quickly find their way to our playlist. You can also join the live streams here, and you can do searches for topics of specific interest, like the fibs that we talked about a little bit earlier today, just by using our search tool. Also, make sure that you're following Barb and me on X. You can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. And if you reply to one of my posts on X, I try to reply right back to you. I check it every day, all day long. I'm having a look at that. Like I asked my followers just recently, who's a college football fan out there? I actually saw somebody discussing. I know there's an Alabama fan out there. Also like to get feedback on chart scenarios and what people are investing in or have invested in, that sort of a thing. Just interesting, get to know one another through that. Best place to connect with us in between these live streams. So give us a follow there. There's my handle again, at Cameron May CS. Okay, there is a survey, so go fill that out now. If you would do that, that would be absolutely fabulous. I will read through those comments and I read that data. It's never a wasted effort. Barb, thanks for helping out in the chat. Thanks for all the thumbs up. I see 140 people watching, and boy, 59 have already clicked the thumbs up. That's always appreciated. Anytime you like one of our webcasts, hit that like button. It helps. All right. I'll see you guys in a future webcast. I'll also look for on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.